taking the time. We'll give folks a few. Hi, everyone. Thanks for joining. We're super excited to have this session today and appreciate everyone joining. We're going to give everyone probably about 2 more minutes before we get started. As we know, there's a few folks just joining now. I know we've had a few more folks join. Just as a quick kind of call out, we'll get started in 2 minutes. We're just giving folks a couple more minutes to trickle in. If you've joined, would love to know where everyone's joining from. Maybe you can enter in the chat where you guys are located or are located right now. Would love to know, and just making sure once we can see folks in chat, we'll get started in the next roughly 1 minute. Awesome, North Carolina. Virginia, okay. All right, Florida. Big fan of Florida. I can say I just left Florida this month, unfortunately, but love living down there. San Diego. Okay, we got all of the coast covered. We're going to get started. Looks like we have a decent number of folks here. So first of all, appreciate everyone joining. We're really excited for everyone to join and really talk about this. And just for the basics, if you aren't aware, this is potentially one of the biggest tax changes is coming in starting January 1st, 2026. The estate tax or gift tax exemption is dropping. And really what we want to talk about today is those changes that are coming, what can be done about it, and how impactful it is, and what are some of those solutions. This webinar is really for folks who are either financial advisors, CPAs, or individuals who are worried about these changes and currently face or will likely face the estate tax if they pass on assets to future generations. This is the second in our series of Valur webinars. We're starting to do these every week, and we love feedback as we continue to improve this. So, and just to give kind of a couple of ground rules as so please enter any questions you have during the webinar in the chat. We will try to answer them when it makes sense. So some of these questions we may answer in real time or in a couple minutes, or if it's not in the flow of things, we'll save them till the end. The webinar we're going to try to keep it to 45 minutes and leave 15 minutes for Q&A at the end. But again, we'll answer some of those questions in real time as well. And before we get started, also just want to give you a quick overview of Valur. A lot of you do know who Valur is, but just this quick highlight. So Valur is really, the goal of Valur is to make tax mitigation accessible to everyone. And what that practically means is taking what does a well-run family office do to reduce their family and clients' taxes, and how do we use technology to make it easy for everyone to understand what are those best practice solutions, what are the quantitative as well as qualitative trade-offs and benefits, and then use technology to make it seamless to implement and administer these structures so it lowers the cost, helps optimize it, and makes it a more seamless experience. And broadly, the idea is that these tools and techniques are valuable to really everyone who's building wealth. And how can we help people understand and utilize them so that everyone can build their wealth more efficiently? And just as a quick kind of overview, I'm Mani Mahadevan. I founded Valur. I founded Valur after dealing with a situation myself I was fortunate to work for a tech company, lived in California that IPO'd, and I was trying to figure out how do I maximize this exit. And as many of you know, it's when you have your assets, a lot of it comes down to taxes. You're not changing the value of the investment, And really, it's how can you minimize what you lose? And that's where a lot of these tax mitigation techniques come in. And that's kind of going through the challenge of how hard it was to understand what were those options and really be able to compare them. And then the cost of setting up and administering it is really what drove me to start Valur. And I'll hand it off to Peter, who's our head of estate planning at Valur, to just give a quick background on himself, and then we'll get started on our webinar.
Thanks, Monty. My name is Peter. My background is I'm actually a trust and estates and tax attorney. I joined Valur in March of this year, although I've been working with Valur for over a year at this point, sort of as a helper. And yeah, so let's get into the webinar.
Yeah, and so key things we're going to talk about, again, this is for folks who are likely facing the estate tax. So, and if you aren't super familiar with this, we'll talk about that as well. But the key things we're going to cover today is what is the gift and estate tax and what is the exemption? What are the upcoming changes that come into effect at the start of 2026? And how that really impacts folks who are facing this and why it's really important to take advantage of the current gift tax exemption. And to just really quantify that, it's one of the big things we do at Valur is what is the value of this? Practically, we know most people don't enjoy taxes. What we do know is people care about this when the dollars and the tax savings are meaningful. So we'll go through a case study to help you understand how meaningful these tax changes are in just kind of a common scenario. And then we'll talk through some of the common strategies and trade-offs that people use to avoid gift and estate taxes. Then we'll open up for Q&A at the end. So just to get started with this, let's start with the kind of the basics of Peter and putting in kind of your report. What are gift and estate taxes, and what is the gift exemption?
Yeah, so the federal government taxes wealth transfers, and it does so in two ways. So first, it taxes gifts, lifetime gifts, and then it also taxes net worth at death. So essentially, a tax on bequests that you leave other people when you die. And so both taxes are basically part of a single integrated gift and estate tax system. So both apply at 40%. So 40% of the gift or 40% of the estate size. The important thing is that both have, basically they use a single exemption amount, which exempts most people from having to pay either gift tax or estate tax. And so until 2017, the estate and gift tax exemption was, back then it was about $5.5 million. And it was doubled by the Tax Cuts and Jobs Act, which was enacted in December 2017. And so effective January 2018. And so the exemption went from $5.5 million to about $11 million in 2018. And since then, it's increased with inflation. So it's now up to 13.61 million, and it'll be about 14 million in 2025. So that's 14 million per individual. So 28 million for a married couple. But when the Tax Cuts and Jobs Act was passed, most of the provisions were temporary, including this one. And so under current law, at the end of 2025, midnight, December 31st, 2025, the exemption is going to be cut in half from what it would otherwise be with the Tax Cuts and Jobs Act. So unless Congress extends the current exemption level, it'll go from about 14 million in 2025 to about 7 million in 2026, which is a huge drop. It's the biggest drop of the exemption amount in history. And if it happens, it'll more than double the amount of people who are subject to the estate tax. So it'll be a pretty big change.
And just to kind of, I know that's a lot there. So, and just to kind of practically break this down for folks, of what this means is, if you're planning to give more than $7 million as an individual to future generations, this likely applies to you. Because to kind of what Peter's calling out is, currently as an individual, you can give $14 million before you face this gift and estate tax. Beyond that 14 million, you lose 40% of it to federal tax. One other piece to add on there is that 40% is just the federal estate tax. There's also some states that have their own state estate taxes. And so that estate tax can rise to over 50%. And what that practically means is today's world, you can give 14 million before you can potentially lose half of every incremental dollar you give. But in 2026, you can give 7 million before you start to lose 50%, potentially up to 50%. Is that right, Peter?
Yeah, that's right. So basically, lowering the exemption does two things. One, it significantly increases the number of people who have this huge tax problem. The other thing it does is for the people who are already over the exemption amount, the $14 million exemption amount, it limits. It makes it a lot harder for them to get assets out of their states. So it's a very significant change if it comes to pass.
Yeah, and just as kind of a practical piece of this is, let's say you haven't given anything. Let's say you're even just giving $14 million, and you don't do anything before 2026. Like, what's the rough kind of upfront impact of this and kind of potential impact over time?
Yeah.
If you miss this window.
Yeah. So the impact is huge, and there's a few different ways of thinking about it, quantifying it. So sort of the simplest calculation is to take the difference between the 2025 exemption amount and what the 2026 exemption amount would be. So that's about a $7 million delta. And if you multiply that
just to clarify, that means 2025, December 30th, 2025, you can gift $14 million to your kid, no estate tax. January 1st, after the ball has dropped, you can give 7 million, and that next 7 million would face at least that 40% tax, right?
Yeah, exactly. And so depending on what state you live in, if you just multiply that by your estate tax rate, that 7 million by your estate tax rate, it's somewhere close to $3 million. But that's actually really understating the real value of this. For people who are going to be over the exemption, it's actually worth a lot more than 3 million for a few reasons. One is, and I don't want to get into this too much, but when you make a gift, you can get a valuation discount a lot of the times on the gift. So if you gift a 50% interest in a $20 million real estate project, that's not a $10 million gift as far as the gift tax is concerned. It's more like a $6 or $7 million gift. And so the $7 million delta is it can actually shelter a lot more than $7 million of gifts. It can probably cover, $10 or $11 million worth of gifting. And then if you factor in state taxes, like Monty alluded to, the number becomes bigger. If you factor in the generation skipping transfer tax, the number becomes bigger still. And then if you factor in appreciation that would occur outside of the estate over the course of the remainder of the taxpayer's lifetime, the numbers become really, really enormous depending on how long they live.
Yeah, and we'll jump into those numbers. And just the one piece I want to call out is really this is applicable, and just to be straightforward, this is really applicable to if you're ultra high net worth and you're going to, as an individual, gift more than $7 million to your kids, whether it's now or you expect to over the course of your life. Like, this is really who this is applicable to. And that's where this is relevant. But just to kind of quantify this, let's go through kind of like a case study we'll go through a scenario where kind of someone who is over this amount does nothing, and they want to leave it to their children, but they don't give anything until they pass away. They give something now before the end of 2025, and they gift after. Peter, want to kind of talk us through this kind of case study and the scenario, the context of it, and then we'll get into kind of what the meaning of the results are.
Yeah, so the context of it is we have a person named Anne. She's 50 years old, unmarried, has a child, and lives in New York City. And she has a $25 million net worth, and she wants to leave her wealth to her her child when she dies. And she's worried about the estate tax, as she should be. And so Anne comes to you and she says, should I make a gift in 2025 or should I wait until 2026? What's the difference really between making the full $14 million gift in 2025 versus making the $7 million gift in 2026? And so we ran the numbers for an intentionally defective grantor trust. The numbers change depending on the type of trust, but we don't have to get into that. But basically, so if Anne lives 40 years, so this is assuming Anne lives to 2065. If Anne lives to be 90, and she doesn't make any gifts, she'll be able to leave her child $148 million. And so that's assuming $25 million grows at a 9% pre-tax annual return, about a 6.5% post-income tax annual return.
And just to call this out, because I'm sure there's a lot of financially inclined folks here, this is after those gift and estate taxes that Peter's mentioning with that growth rate. So this is after kind of everything that she loses.
Exactly. So it grows to close to 300 million, and then it gets cut in half by taxes. So New York State has its own estate tax, and the effective estate tax rate in New York State is basically, it's really 49.6%. So so in the no trust scenario, she winds up leaving $148 million to her child, which is a lot. But if she'd made a gift in 2025, the $14 million gift to intentionally defective grantor trust, she actually would have left closer to $300 million to her child. And if she'd made a gift in 2026, a $7 million gift, she would have left $234 million to her child, which is better than the no trust, but obviously a lot worse than making the gift in 2025. And by the way, this is assuming no valuation discounts, and it's not accounting for some of the other factors that could make these numbers actually bigger. And so these are actually pretty conservative figures for the situation.
Yeah. And it sounds a little bit weird to say, right? But in a conservative world where essentially you gifting this money now before the exemption changes can essentially enable an individual to pass on $100 million more to their family. It sounds kind of crazy to say. Now, one thing to call out is, so I'm sure some folks on here have used our calculators. We do have a calculator that actually runs through all these numbers. We're actually releasing it in August. So we'll share updates with that, but you'll actually be able to not only see the impact of these numbers in these different scenarios, but also Peter's kind of mentioned this, and we're not going to talk about it now, but there's a number of different estate planning structures and irrevocable trusts that people use. You'll be able to see how these numbers change in these different scenarios. To better understand this, and we're also always available to, you can set up calls with us to better understand this, better understand these structures and how to use them. So, I mean, the real call out here though is just how important it is, one, to do estate planning. If you're worried about the gift and estate tax, it is, literally $100 million decision. And also the value of doing it. There's this unique window before the exemption lowers, right?
Yeah, exactly. And it's just, I think the big takeaway from this is really, it's not just about the importance of using the gift tax exemption before it's cut in half. It's also just the importance of estate tax planning in general. As Monty was saying, these numbers are conservative. The numbers in general for estate tax savings are enormous. And a lot of the strategies, you end up saving both estate tax and income tax, or at least state income tax. And so, especially for people in higher tax states, you can really save. You can more than double the amount of money going to your children using these strategies, especially if you have more than a decade or so to plan around.
Yeah. Now, hopefully kind of really the takeaway is if you're planning to gift money to future generations and you have or will plan to give more than 7 million, the value starting to do it sooner. The next kind of common question that comes up is what do I gift it to? What are the different structures to use? So we're not going to go too in depth today. That's for kind of a different webinar, or if you want to chat one on one, we're going to kind of high level chat through what are some of the most common strategies for that people use to lock in the exemption today, but more broadly, pass on assets to future generations in a tax efficient way and protect those assets for their children. So Peter, maybe we can start with kind of just high level of just a quick overview of what these structures are and what's the kind of when are the common use cases for them? When does someone use an IDGIT or
Yeah.
an ILIT or a non-grantor trust?
Yeah. So high level. So an IDGIT, potentially defective grantor trust, is a trust that's outside of your estate for gift and estate tax purposes, but it's disregarded like kind of like a single member LLC for income tax purposes. And so it's probably the most common estate tax planning vehicle, super ubiquitous. Um, so typically people will set them up for the benefit of their children or maybe grandchildren. But
What's this common scenario of like who's the
yeah,
parent or the grantor? Like what is their situation if they're choosing to set up an IDGIT typically?
yeah. So it just makes sense for a lot of people, just because they're so powerful for estate tax savings. But in general, like the most obvious candidates would be anyone who's significantly over the estate tax exemption amount or expects to be. So even somebody with $10 million now, if they're youngish or middle aged, they'll be way over the exemption amount by the time they die. So it would make sense for them. It makes sense for people even with lower levels of wealth who expect to be close to or over the exemption amount if they live in lower tax states. Um, if someone's sort of close to the exemption amount and lives in a higher tax state, we might recommend number 3 on this slide, which is the non-grantor trust, which is a type of trust that's a separate taxpayer for income tax purposes and estate gift tax purposes. And so the reason these are really powerful is they can save state income tax as well as state tax. And so if you're in New York or California, you can set one up in South Dakota, for example, which doesn't have an income tax. And and the trust will not only grow outside of your state for estate tax purposes, but it also won't generate any state income tax liability.
And just because I know this is where we're not going to go too deep in this, and we know these things are confusing, which is why we're happy to chat one on one. But just to kind of going back to the IDGIT, the IDGIT again, core use cases you are or expect to be significantly over the state exemption. And Peter mentioned this of it can sound confusing of it's outside your estate for estate taxes, but inside your estate for tax purposes. The real kind of impact of this is you can essentially pay the taxes of the trust without it counting as a gift to the trust. And that may sound inconsequential, but it practically means is over the long term, you're able to, for folks who are over the state exemption or significantly over, they can actually get most of their assets outside of their estate because of that feature. And this is where it may not seem like much, but it is a really, really powerful structure and why it is kind of the go-to, as Peter was saying, the most common. So if you're over or expect to be over, this is a great way to move these assets out of your estate and ensure that you essentially completely avoid estate taxes. And obviously, avoiding a 40% plus tax is really significant to maximizing what you can pass on to future generations. And I'll call out just one other quick benefit while we're talking about it is a lot of people are also worried about, hey, what if I give too much to this trust and I can't access it? One big benefit of IDGITs is you can give yourself loans. You do have to pay interest on it, but it means that you do have access to liquidity. Am I kind of missing anything with those two kind of key benefits, Peter?
Yeah, and the other thing on loans is the loan interest isn't taxable when you borrow or lend to an IDGIT because it's disregarded for income tax purposes. So it's like as if you're loaning money to yourself. So there's There's no tax consequences of the loan.
Yeah. Now, going back to Peter started talking about this with non-grantor trusts. Non-grantor trusts are their own tax entity. And so part of this is you can't pay the taxes for it, that benefit that you get from an IDGIT. But the most common place to cite these are no tax states like South Dakota. And really the arbitrage is, let's say you're a Californian. I used to live in California, which is part of how kind of what drove me down this path is you pay really high taxes. You know, you can be paying, most of the folks who are looking at this, maybe paying 13% for their capital gains. And hey, if you lose 13 cents out of every dollar, that's a significant chunk of change. But if the trust owns it and it's based in South Dakota, you can avoid that 13% tax. And so it is, you could move the assets outside of your state and lower the tax rate that you pay when you sell those assets. Is that right, Peter? Or am I missing anything?
Yeah. Essentially, the trust is treated as a resident of the low tax state or the no tax state, and so it's taxed the same way. You know, somebody who lives in South Dakota would be taxed if they made an investment. So,
yeah. And another common use case doesn't come up as often for folks, but the non-grantor trusts are often also used for QSBS stacking because they're their own individual. Folks who have more than $10 million in asset may set up a non-grantor trust, transfer their eligible QSBS shares to get a second $10 million exemption. And by the way, Stefan, we see your question. We'll kind of get to that. One thing I want to ask you, Peter, is we said kind of IDGITs are one of the most common solutions for folks who are worried about the estate tax. Who doesn't it make sense for?
So there's no one for whom I would. So anyone who's going to be subject to estate tax or thinks that their estate's going to be subject to estate tax, I think it makes sense for anyone to do an IDGIT if they're in that situation. There's no one for whom it makes no sense. I think that a lot of times people who live in high tax states and are close to the exemption amount, not like billionaires, are attracted to the idea of saving state income tax. And so they like the idea of saving lots of state income tax, even if it means a little bit less estate tax efficiency. But it arguably makes sense for just about anyone who has a significant estate.
Yeah, essentially, if you're over or expect to be significantly over the state exemption, IDGITs are likely part of your solution. If you're close to the exemption amount or in a high tax state, they may be part, but they'll be probably a lower allocation of your assets or not part of your plan. Is that fair to say?
Yeah.
And so I guess kind of taking that question, who doesn't a non-grantor trust make sense for?
Yeah, so a non-grantor trust doesn't really make a ton of sense for people in low tax states like Texas, because one of the big benefits of a non-grantor trust is the state tax savings. The one reason people sometimes set up, well, aside from what Monty was mentioning, which is non-grantor trusts can get their own QSBS exemptions, $10 million QSBS exemptions for people with QSBS eligible stock. But aside from that sort of narrow situation, it doesn't make a ton of sense for people in low tax states to set them up. There's a lot more flexibility with an IDGIT, and the estate tax savings from an IDGIT are more powerful than the estate tax savings from a non-grantor trust.
Got it. Now, the third kind of structure we talked about is kind of in ILIT. Maybe let's start with what does that stand for, and what's the common use case for using one?
Yeah, so ILIT stands for Irrevocable Life Insurance Trust. It's a type of trust. It's very similar to the IDGIT, but it's a type of trust that's specifically designed to hold life insurance. And so typically what happens is people will gift cash to the ILIT, and then the ILIT will go out and acquire a life insurance policy on the life of the grantor or donor. And then when the donor dies, trusts are created for the benefit of the donor's children or grandchildren, whatever they want to do. and the proceeds, the insurance proceeds, are entirely outside of the donor's estate. So it's a big estate tax savings.
That makes sense there. There's a question from Stefan here, putting this up on screen. Which
Yeah.
trust option offers the most asset protection while the client while the client is alive? Um, is there a clean way to answer that, or maybe talk about the other factors that can kind of impact this, like where the trust is located,
Yeah.
when you fund it?
Yeah, so that's a good question, and one of the big benefits of sort of estate tax planning is you get a lot of credit protection from gifting assets into trust. And so in general, all of the trusts that we're talking about today create a lot of credit protection for both the grantor and the beneficiary. The certain types of trusts create
Hey,
less.
before we go farther, what does creditor protection mean?
Yeah, so it's protection from uh, all types of creditors. So creditors could be the neighbor who falls walking on your driveway or something and sues you. Could be some business litigation issue. Could be divorcing spouse who's going after uh, the uh, their ex spouse's assets. Um, so any person who claims some share to your assets for whatever reason.
That that makes sense there. Um,
Yeah.
so
So
that's kind of
the one other thing I'd add to Stefan's question is, so all of these trusts, non-grantor trusts, idiots, slats, islets, provide a lot of asset protection. The one factor that matters is the state that the trust is created in. So some states have a little bit stronger asset protection laws than other states. So, for example, South Dakota, Nevada both have very strong asset protection laws, and it's very, very hard for creditors to go after either the beneficiaries or the grantor of a trust created in one of those states and get to the trust assets. Um, but even if you set up a trust in California, an idiot based in California, you get a lot of credit protection relative to almost any other structure.
yeah. And one piece to call out is these are some of the most common structures people use to pass on assets to future generation for estate planning. But there are other structures that people use. We don't want to go too deep into it in this call, just because it can get confusing. And we're going to do specific webinars on each of those structures. So, piece that's call out is, one, let us know if you have other questions that you want us to answer now. But also, if you want to chat more about it, you can set up time one-on-one with us, or we'll send out updates on these webinars and some of new calculators we're releasing that'll help you understand what is the value of using these different structures. What does that mean from how much you're passing on to how much liquidity you have um, moving forward. And there's just kind of couple pieces to call out. Feel free to email us directly. We'll also have our next webinar is on Crummy Trust. Peter, do you want to give kind of just a quick overview of what Crummy Trusts are and who it's
Yeah,
applicable to?
yeah. So in addition to the $13.61 million lifetime exemption, there's another exclusion from gift and estate tax called the annual exclusion, which you've probably heard of. It's currently $18,000, and so that means that you can gift $18,000 to any beneficiary you want every year without using any of your lifetime exemption amount. And so sometimes people will make gifts to outright gifts to their children, but sometimes people use trust instead. And so a crummy trust is a type of trust which you can create through Valur that that qualifies for that $18,000 annual exclusion. In the for people who are really, for anyone who thinks they might have an estate tax issue in the future, Crummy trusts are a sort of inexpensive, simple, easy to manage way to save potentially millions of dollars of estate tax over the long run. So,
And just to kind of clarify that last point of one of the things we do at Valor is we help people set up these trusts for free at no cost, which we know for those of you familiar with it, that's obviously kind of unprecedented. And then to be transparent, the way we make money is we charge for the administration, the ongoing accounting, tax filings, and administration as for these trusts. And that's part of it. We're typically somewhere between 20 to 30% the cost of a trust company. But again, our broader piece is how do we help people understand these structures and make it easy to access and utilize them. Please let us know if you have any other questions you want us to chat through. Otherwise, if there aren't, we'll end the webinar a little bit early. And again, you can set up time with us directly. We'll let you know when we have these calculators so you can actually see what's the value of this. Or join us on our kind of these webinars as we talk through these structures in more detail in future weeks. Perfect. Looks like kind of folks have gotten most of their questions answered. We really appreciate everyone taking the time to join us. And look forward to hopefully seeing most of you guys next week. Take care.